Hello everybody, welcome to Angel Traders. This is Derek Vandelander, the creator of the Angel Trader strategy. Today I'm going to be doing a video on the Forex basics, so let's get started here. What is Forex? Forex is a short form of foreign exchange. It is also known as the currency exchange or just simply FX. Forex is the absolute largest financial market in the world. It has a daily turnover of $5 trillion. And to put this into perspective for you, the New York Stock Exchange only does 22.4 billion daily. However, here at Angel Traders, we are called retail traders. We average 1.5 trillion of the daily turnover. Who is the biggest players in the Forex market? The biggest players in the market can change the currency rate in the blink of an eye. So you must know who they are. Mario Draghi, Janet Yellen, and Angela Merkel are just a few of the officials who can create huge movements in the market. They speak during news events, and just a few words from them can change the market price. News in the markets. Retail currency traders often plan their trades by analyzing the most recent economic news and geopolitical developments, as well as the latest announcements from the G7 officials. The G7, which is the group of seven, is a form of the world's 7 most developed economies: the US, Germany, United Kingdom, France, Japan, Canada, and Italy. The main people to follow and listen to are the head of the central bank, the prime minister, the president of a country, chair of the US Federal Reserve, head of the Euro Central Bank, president of Germany, and the president of the United States. The biggest players in the markets. 1. Governments and central banks. The biggest players in the markets are governments, central banks that buy and sell currencies to balance the economic growth and price stability of their nations. The amount of money used by central banks is enormous, so their actions have a deep impact on the currency markets. That's why every Forex trader waits with a bated breath whenever the chairman of the US or European Central Bank is speaking publicly. One sentence in their speech can create huge fluctuations in the market. And I'll be going over this later in a different course for you guys. Commercial and investment banks. Big bank trades billions and billions of dollars daily. They make transactions with each other and with their customers or themselves to speculate on the Forex market. The 5 biggest banks are Wells Fargo, Industrial and Commercial Bank of China, JP Morgan Chase & Co., China Construction Bank, and Bank of America. 2. Large corporations control large amounts of money, so when they move their assets in bulk, it can influence the currency rates. For example, when the biggest insurance companies in Japan started moving their assets out of a country because of the decreasing value of the yen and decreasing interest rates, the yen fell even more. 3. Individual traders. The most popular Forex trader is George Soros, who is famous for breaking the Bank of England and earning $1 billion in a day. He also earned $790 million by speculating on the fall of the Thai baht. Traders like George Soros usually operate hedge funds with large resources. They can create strong impact on a nation's economy and currency rate. How does Forex trading work? Go long or go short. Sell high, buy low. The main idea in the Forex market is to buy a currency at a low price and to sell it at a higher price. If you think the price of a currency rate will go up, you click buy. This is called going long. But if you think the rate's going to go down, you click sell. This is called going short. The process is going long is very simple. Going short in reality is a bit more complex. Fortunately, the complexity is taken care of by automated trading systems. The shorting process happens like this. The broker lends you the currency that you want to sell. When the price falls, you pay the broker back at a lower price, thus making a profit on the difference. All you need to do nowadays is push a button and the shorting happens automatically. It is important and also fun to understand that you are not simply trading money in Forex. You are trading economies and entire countries. If you are buying British pounds, you are in essence buying shares of the British economy. For example, if you pay with US dollars to buy the pounds, you do it because you believe that the UK's economy will outperform the US economy. The price of a currency in reality is a reflection of what the market thinks about in the current and future condition of its economy compared to other economies. When to trade Forex. Forex trades are carried out from different time zones all over the world. So when the market open, with the market being open 24 hours a day, giving traders the freedom to choose when to work. But it is truly active and profitable all the 24 hours. No, it's not always a volatile market. Quite often, beginners are misled by the fact that currency trading happens at all hours, so they start trading in times when nothing happens as it should. There are specific times when the activity and liquidity peaks, and these special times are when the most active sessions overlap. During the overlapping of sessions, the flow of transactions and money is the highest, thus fueling the currency in fluctuations and forming notable trends. Knowing the best time for trading is critical for success. In this section, you will learn when the best market hours of the day are for trading, which day of the week is most productive, and which trading sessions are considered to have the most potential. When to trade Forex. What is the busiest session? The busiest session of all is London session. 30% of all trades happen during this session. Session overlapping. The best hours of trading are during the overlapping of major sessions. The most important one, London and New York. As you can see in the right hand corner, this is going to be showing you a picture of what the sessions are. The most active time of the week is from Tuesday to Thursday. The best times of the day of trading, the most active trading sessions are in London and New York, so the highest market liquidity is when the sessions overlap, as both continents are online and actively trading with each other. This creates big fluctuations in the currency prices, opening more notable opportunities for making gains. Keep in mind that during the last session, the last minutes of London session, the currency swings can become quite chaotic and thus harder to predict. The opening of London session is also very active and lucrative as it overlaps with the end of Tokyo session. The third major overlap happens between the Sydney and Tokyo sessions. Still, this time is less liquid than London and New York sessions, as it is late evening or night the rest of the world. The best days of the trading of the week are, most active days are in the middle of the week typically. It's usually on a Tuesday, Wednesday, Thursday, and sometimes Friday mornings are very active. The last hours of the day that can be sometimes chaotic, so always avoid them. Just remember that if you don't have to trade all of the sessions, it is neither sustainable nor productive in the long run. When not to trade Forex. Save your money and keep your nerves by not trading at the wrong time. While it is crucial to understand what is the best time to analyze the charts and make bids, it is equally important to know when not to open positions. There are two main characteristics of bad timing: low activity in the market and chaotic direction of trades. An active, often called thin market, offers smaller movements of rates, thus making smaller potential profits. A thin market also comes with a higher commission, also known as spread, for each trade due to the decreased liquidity. In simple words, if you want to sell a currency, it is harder to find a potential buyer, so the commission goes up. A good example of chaotic trading is shortly before, during, or shortly after news events. In this time of uncertainty, the currency rates can swing wildly and unpredictably, thus messing up trading by creating execution lags, triggering stop loss orders, etc. So here are some examples when you should at least be careful when trading. Friday afternoons and weekends. The activity slows down in the second half of Friday, mainly because the big banks and hedge funds are closing their positions for the weekend. This is mostly done for security reasons. They don't want to have their large positions left open without sufficient supervision. The biggest risk of leaving positions open for the weekend is called the weekend gap. When bigger rate swings occur while the systems are not recorded, the stop loss orders might not be executed correctly and create problems. That is why most traders don't leave open positions over the weekend. Trading session closing times. When the trading sessions are closing, the rates and liquidity can swing wildly, resulting in slips, high spreads, and overall losses. Bank holidays. Trading usually slows down during major holidays, so before trading, it is wise to mark your calendar for the major holidays of the countries. Primetime TV events, World Championships in footballs, NFL, Super Bowl, X Factor, etc. can create the same effect as holidays. We won't find these events in the economic calendars, so a TV program guide can also be a useful tool for a trader. Asian sessions. Traders, especially beginners, should be careful trading during the Asian session, as the market activity is usually very low. This results in higher spreads and smaller gains. You should not trade when angry or frustrated. A golden rule of trading is to stop trading when you're angry or overly excited. Trading during elevated emotional states usually ends badly because it affects people's mental sharpness. You must be calm and collected when trading. Overnights. Many Forex brokers charge fees for leaving overnight positions. Check your broker's policy on the overnight positions. Currency pairs. Trading Forex means simultaneously buying one currency and selling the other. Currencies are traded through a Forex broker or a bank, and they are quoted and traded in pairs. This is how they typically show you right here. We got the Euro USD. The base currency is the Euro, EUR. The quote currency is the US dollar, USD. The bid price, you can sell 1 euro for $1.47 technically. Ask price, you can buy 1 euro for $1.47. There's a 1 pip spread right there. Currency pairs. The most popular pairs are those that include the US dollar. These pairs are called majors because they're often traded most often. As you can see on the picture to the right, this is the pairs that are frequently traded the most. Currency symbols always have 3 letters, where the first 2 letters identify the country and the third letter stands for the country's currency. Take AUD for instance. AU stands for Australia and D stands for dollar. These pairs to the right will be the easiest for beginners to trade. Key Forex terms, bulls and bears. What is the first symbol of financial markets that pops into your mind when you think about Wall Street? Most popular probably is the bronze sculpture of the charging bull. This iconic bull is the symbol of aggressive financial optimism and prosperity. It has an opposite characteristic of a bear, and together they represent the dual nature of the financial markets. The term bullish market and bearish market are often used when describing the underlying trends of the market. Bull market or bullish market is when the market is showing confidence, currency or stock prices are going up. A bullish trader believes the market will rise. This term is used because when the bulls fight, they throw their opponents up in the air with their horns. Bear markets. also known as bearish market, is when a currency or stock rate goes down. Bearish traders are the ones who believe the rate will decrease. When bears fight, they push their opponents to the ground. This is how you can remember how to distinguish between the two terms. Key Forex terms, a pip. In Forex trading, a pip or pip is short for percentage in points and is a measure for exchange rate movement. The pip is a unit, a numeric value that ultimately measures profit and loss. A single pip is equal to 0.0001. Forex traders will often quote the movements, profits, or losses in pips. For example, stating something like, I made 30 pips on that last trade, or the AUD USD has gained 30 pips in the last hour. Global currency prices are displayed to the 5th decimal place, fractional pips for improved precision. Our spreads can be too small to be seen with only a 4 decimal place. As you can see right here, 1.2712 to 1.2713, that equals 1 pip movement right there. Spread. A spread is the pip difference between the bid and the ask price of an underlying asset. As it is essentially the cost of making a trade, it is important for Forex traders to know what spreads are. To find the spread, we minus the bids, also known as the sell, price from the ask price, which is the buy price. From the example taken from the trade terminal below, the AUD USD is currently priced at 0.93860 over 0.93865. AUD USD buy price minus sell price equals spread. So 0.93865 minus 0.93860 is 0.00005, or also known as 0.05 pips. Half a pip essentially. The MT4 trade terminal will show the spread quoted in pips between the two prices. Spreads are always variable, and as we source our feeds from as many as 70 different institutions, we can provide lower spreads. To compare the spreads between different currency pairs and other Forex providers, please see below. Leverage. Leverage is the ratio at which defines the loan amount, margin that traders are allowed to use to gain access to larger sums of trading capital. Leverage can heighten both profits, and it can also make you lose more. It should be used wisely. Due to the nature of leverage, Forex providers like MXT Global have strict leverage restrictions in place to assist traders in minimizing risk. Let's look at numerical examples. Say true traders have 5,000 USD. They both wish to use 1,000 on one trade as a margin. A trader has an account leverage of 10 to 1, and trader B has account leverage to 100 to 1. The exposure they both have differs due to the difference of their account leverage ratios. Let's take a look right here to the right. That is showing you the different leverage needed with the different ratios. Margins. In Forex trading, a margin is required to trade. Margin can be considered as the minimum collateral or deposit. This margin allows you effectively to take a loan, access to a larger amount of capital. How do you calculate the margin per trade? An account leverage ratio is used to determine how much margin will be acquired. Overall lot size, leverage amount equals margin required. Example, with 2 lots at a leverage of 400 to 1, 200,000 over 400 equals a $500 margin. A margin call is a notification you will receive when there are not enough funds in your trading account. Support open trades, essentially when your floating losses are greater than the minimum margin required. MXT Global's margin call level is at 80%. Lots. If a trader could open a trading position with just 50 cents or $1, the trading would not be worth anyone's time, as it would take years to gain significant profits. Currency rates usually don't have enormous swings that can generate 100% profits in minutes or hours. So trading becomes productive only when deposit can reach a certain limit. In order to not waste traders' time, currencies are traded in minimum packs called lots. Just like beers are sold in 6-packs. The standard size of a lot is 100,000 units of the base currency. However, there are also smaller types of lots for people who don't want to risk too much money. Mini lot is 10,000 units of a currency. Micro lot, 1,000 units of a base currency. A nano lot is 100 units. So as you can see the picture below, this kind of gives you an example of the different lot sizes and what profit you will have on 1,036 pips. So can you still make money with a small mini lot or micro lot? Yes, it takes longer, but it is definitely possible. All right, so these are just some of the very basics of what Forex is actually is. If you want to know more about the very basics, I recommend downloading the app, Forex app called Forex Hero. I know it is on the Android market and on the Apple market. So now what you want to do is you want to go to the next section on MT4 chart setup, and we'll get going.